The market is aggressively pricing a US-China trade war de-escalation. With China's exports jumping 14% year-on-year, this summit optimism is driving major Asian equity indices to record peaks. But that broad enthusiasm misses a rapid deterioration in Asia's largest anticipated growth engine. Investors are dumping Indian assets, the rupee is sliding, and multinational back offices face immediate disruption. The single convergence narrative is a mirage. Emerging markets are actually experiencing a severe structural bifurcation, and the money chasing the indices is entirely blind to the fracture. The blind spot starts with the IMF. Their April 2025 Article 4 report projected India as the fastest-growing major economy, at 6.2% GDP growth. However, those baseline projections relied entirely on energy import costs calibrated to a pre-Iran war baseline. That assumption is no longer operative. This chart demonstrates the balance of payments loop now driving the FX market. A depreciating rupee amplifies the cost of each imported barrel, widening the current account deficit, which puts further downward pressure on the currency in a self-reinforcing cycle. India's balance of payments mechanics have moved completely beyond the IMF's modeled parameter range. Compounding pressure is pushing import cover risk dangerously close to the critical 9-month threshold. Prime Minister Modi's recent BJP landslide provides strong political narrative cover, but it offers zero balance of payments relief. The market is pricing the landslide while completely ignoring the underlying threshold. The second structural fracture hitting emerging markets originates in Tokyo. The era of cheap Japanese liquidity is ending. Governor Kazuo Ueda's explicit signals for a June rate hike have now received their second consecutive week of data confirmation, with March wage growth printing highly supportive of immediate tightening. This diagram illustrates the structural dependency. Carry structures funding duration positions in Pakistan, Egypt, and Kenya were built on the assumption of continued Bank of Japan accommodation. That window is explicitly closing. The headline emerging market debt spread has tightened to 243 basis points, driven almost entirely by tech flows in Korea and Taiwan. Underneath that falsely compressed surface, frontier funding costs are spiking. The yen carry funding regime change is a mathematical reality. The unwind timing remains uncertain, but the direction does not, leaving high-yield frontier economies exposed. Positioning demands caution on India across the capital structure. Additionally, reduced duration in high-yield frontier credits tethered to the yen carry unwind. Conversely, we are constructive on Angola. The Japanese government's recent Africa tour secured deeper involvement in Angola's oil and mineral sectors, providing a strong bilateral external backing signal that current sovereign spreads do not reflect. We also remain asymmetric on Uzbekistan. A recent London IPO validates rare capital access for the region, provided institutional reforms keep pace with that market access. China's export strength and India's economic deterioration are separate realities. The convergence narrative is ignoring the energy import shock, and betting on a unified trajectory across the emerging market complex is an expensive mistake. For exact execution parameters and full trade positioning details, access the unredacted blueprints at the terminal link on